Welcome to Pathway to Property, your go-to podcast for building a property portfolio and breaking down property markets.
Hello, everyone, and welcome back to our next episode of Pathway to Property. I'm your host, Lachlan Vidler. I'm joined, as always, with my co-host, Clifford. Lukey, what's going on, mate?
Mate, very excited to be jumping into this episode with you. I think, obviously our first episode was going through goal setting, and the second episode was planning out the acquisitions.
Yeah.
I'm pretty excited for this episode, mate. We've
You're
got
excited.
a lot in store for our listeners.
What are we gonna? Why don't you give me before we go for a bit of a chin wag and talk a bit of crap for a minute. Why don't you tell everyone what are we in for today? What are we going to discuss?
Well, today we thought we'd make it a bit of a juicy session. We'll talk about market pressure indicators.
Yeah, unreal.
Okay, and I think a lot of people that are pretty new to this might not actually know what this means, and we're going to dive into this into quite some depth today. But the reason why we thought we'd bring it up is because a lot of the people that I speak to day in, day out, property investors that are looking to get into the market themselves, when I'm having conversations with them, I really try to unravel what their process would be to try to get into the best performing market in the country. And I would say 9 times out of 10 of those, Lachlan, most of them tell me that they look at things like infrastructure, job growth, population growth. And, let's not beat around the bush. They are important factors to evaluate, but they are more indications on what your medium to longer term growth prospects look like. Where a lot of people neglect are looking at those market pressure indicators to get that indication on what the shorter term growth is going to look like.
Absolutely. I couldn't agree more. And I think that one thing a lot of people struggle with is understanding how to actually analyze the property market. And I like that you said that a lot of people talk about those sort of bigger picture macro factors like your infrastructure or your population growth or any of that stuff. But honestly, these days I find a lot of that stuff like they're buzzwords, and it's slick marketing, and you see it, like you always see it on house and land package stuff. It's, it's slick marketing, and it gives the implication that, if this is happening, then this other thing must occur. But that's not always strictly true, or probably more importantly, it's not necessarily strictly true in the shorter to medium term, which, if we look at two people, let's say you got person one, it's almost like the old, remember the old super ads, the compare the pair sort of things? It's almost like that scenario of where you got one person who starts today, they're buying a property that's got, obviously good long-term factors, but also really strong short to medium-term factors. And then you've got somebody else who's sort of just a bit of a longer-term person, hasn't really necessarily thought about the shorter term. And the shorter to medium term stuff is what allows you to then leapfrog into your next property and then the one after that and the one after that versus the one who doesn't do that. And then 20 years time, both of those people, their first property has probably proportionally, so percentage-wise, grown the same amount as each other. Yeah. But the difference is that person who didn't also take into account the shorter to medium term factors, they've probably built a portfolio half, if not a third of the size of the other one because they didn't see that performance.
Couldn't agree more. And I think you would agree with me, and I know a lot of our listeners would agree as well, that you could literally buy anywhere in Australia. If you're holding that property long enough, you're very likely going to make money. But anybody can do that. There's no skill involved, but that is not investing as far as I'm concerned. Investing is, how can we go about getting that growth at the front end of a 10-year period as opposed to that middle and back end? Because if you are wanting to set yourself up so you can tap into that equity and put it into the next opportunity, that early growth is really critical.
Absolutely. And I think the only thing I'd put on top of that is we want to front load the growth, but also we want to do it in a way where, we're not in, say, a mining town where it's only front end growth. We do still want to see a little bit on the back end. The difference is that we just want to have that middle period where maybe it does start to even out a little bit, right? But that's when you then leapfrog into your next one and your next one, your next one. But I completely agree with your sentiment. I think that it's, the really strong and sophisticated property investors, they're the ones who understand how to see the short term, the smaller picture, as well as the longer term, bigger picture as well. And that's the struggle, right? So before we jump in, I thought I'd just I'd bring it up and mention it again. because I believe we mentioned it in our last episode that we recorded. But in really exciting news, Atlas, our company that we love very much, Atlas Property Group, as well as myself personally, we've been nominated for a bunch of the REB, the Real Estate Business Awards, which are the premier real estate awards in the country. So me personally, I've been nominated as Buyer's Agent of the Year, which is super exciting.
So you get all the credit.
You jumped in before I could say it. Naturally, all supported by a massive team, including you.
Thank you, mate.
But I think just great. I see it as team recognition. And then second and thirdly, we've also been nominated as a business for Innovator of the Year, and that's for our incredible tech platforms that we've built out, which is our built from scratch data analysis platforms, our portfolio modeling platforms, our performance management, client management platforms, all built from scratch and helping us obviously achieve those results for clients. And I guess fortunately, with me leading that, I've also been nominated as Innovator of the Year as an individual. So we've got Innovator of the Year company and individual for the same thing. But I guess one's a bit more focused on the leadership side rather than the other one.
Yeah.
But,
and I think it's good that you're sharing that with our audience, because a lot of the time when I speak to clients on the Zoom calls that I do all day, every day, they ask me, where do you guys get your data from? Right. And obviously it's a mix. It's a bit of a mixed bag, and maybe you can expand on that a little bit. Like we've obviously got our external data sources.
Yeah,
but
absolutely.
We've got our own proprietary software.
Absolutely. Well. And I think considering what we're about to talk about today being market pressure indicators, obviously very data heavy, very much in the ones and the zeros, I think it's really important that people understand that, we are experts in this, right? Like, and not only are we experts at understanding it, we've also built systems to help us do it better and faster rather than just your traditional Excel spreadsheet, or probably most importantly, most other people out there, and by people I mean individuals who are just individual property investors or other property businesses, they go and take data and use data through an interface that is owned by somebody else. And the issue that comes with that is if you want to do things that are outside of that interface, you can't do it because you don't own the platform. But because we built ours from the first line of code up, if we decide, we want to, have a different way to look at our data, or we want to do this, or we want to do that, we can literally go and change our platform. And that allows us to have that continuous improvement and continuously chasing, that in finance terms, it's that alpha, it's that factor that we generate ourselves because of our knowledge and expertise, right? It's that unexplainable factor that comes just through having the right people looking at the same pieces of information as somebody else. So exciting stuff, right?
Very exciting, mate. And I think today, obviously, we utilize our own technology to pull data on the factors that we're speaking about today, your market pressure indicators. And we're looking at it at 3 different levels. So we've got the supply level, we've got the demand level, and then we've got the rental level as well. So I guess before we dive deep into each of those, maybe just kind of share with our audience the importance of looking at that.
Okay. Yeah, I think
first of all,
I could probably do that for you, Lukey.
Please.
I could do that for you.
Thank you.
No, look, Matt, I really like where we're going with this because, and I'll say, these are, we look at all these factors. We obviously look at more and other factors, and a lot of that comes down to the fact that we have access to data sources from some of the biggest names in the country that other people just financially wouldn't be able to afford to pay for and wouldn't have the access or the expertise to be able to utilize. But the factors we're going to talk about today, they are factors we use, and that's why I think we want to talk about it, because if you're out there and you're looking at how to do this and run it yourself, these are things that we look at. And if you get a bunch of these things right, you'll probably do okay for yourself, So why are they important? Well, market pressure indicators, or just market indicators, they help us to understand where a market is at. Because like we were sort of talking about before, at the end of the day, if you buy anywhere, not like, in a relatively established market, but you buy anywhere, in 20 years' time, that property is going to be worth more than it was today, and it's probably going to have roughly grown at the same, at an averaged out same rate as anywhere else. The difference
kind of even out in the wash.
Exactly right. It's just, how does that growth occur? Does it do it early? Does it do it mid? Does it do it late? Does it do it early and late? Does it only do it once? Does it do it 3 times? it's about understanding that. So market pressure or market indicators help us to understand where a market is at. And by understanding that, we can then go, okay, well, if we're trying to say front load some growth, we can now go, well, we've got some metrics to help us do that, right? Like for me, I would say that is the single biggest reason of why it's really important. But I think when you start to get into the weeds of it, it helps you in your search, right? Because it allows you to filter down markets quite quickly and know this whole big bulk, it's not for us right now. And it also helps you to remain as unemotional as possible. And like we see it every day, right? Like we see it when we talk to clients about a potential purchase. You see it when you're talking to, clients who are coming to work with us. Property is an emotional business, especially given the stakes. People put a lot of money out there.
Yeah.
But, we've got to try and keep a level head. And by having, metrics that aren't really refutable, you can't argue with the data. I find it goes a long way to being able to strip out some of that emotion. And the reason why that's important is it makes you keep a level head.
Yeah, I couldn't agree more. But I guess why do you feel that most people don't dive into that kind of stuff? Like they just look at your high level factors, as I mentioned earlier, infrastructure, job growth, population growth, those kind of things. Why don't they dive a lot deeper into these kind of metrics that we're talking about?
I think there's probably a couple of reasons. I think the first reason is most people genuinely don't have the knowledge of property markets or data analysis techniques to be able to do it, right? So like take me, for example. Obviously, I'm the owner and founder of Atlas, and now our team is exponentially bigger than when it was just me. But we started with me, and I have a master's degree in finance. I've studied property investment at the master's level as well, right? I've got a degree in property investment. So I have a very technical background that allows me to see it. And then obviously, as you know, people in our team also that are in, especially those data analysis type roles, have a technical background. So I think the first reason why people don't do it is because they don't have a technical background to understand how to do it. And then I think the second reason that stems from that is probably then a lack of confidence because they know that they don't know how to do it, but they're not maybe then sure how to go about learning it. And I think the third reason would be access. So there's a lot of great free sort of data out there. And yes, I would say that data is in a lot of cases quite good and it will help you from making a catastrophic mistake. But the way that I look at it is 91% of investors never make it past one or two properties. And I've talked extensively across, a lot of different podcasts. I don't think I've said it on our one yet, but on a lot of different branded podcasts and things like that, that I think a fundamental reason why that's the case is because people buy the wrong properties at the wrong time. And because of that, we link that back to what we're talking about here of why they don't look at those factors, because they don't have access to the data. They don't make catastrophic mistakes, but then they don't have access to the good data. So, if you're just using the same data as everybody else, like odds to say you're going to end up with a result the same as everybody else. And the same as everybody else is the 91%, which is only one or two properties. So that access to data, which unless, you have a shitload of money to be able to spend on it, i.e. a business level, you're not going to be able to get those high fidelity insights because you just don't have it. Like it's to me, it's as simple as that.
Yeah. And how about for those listeners that feel like they do have the financial capacity to invest in those tools, do it themselves? From my perspective, it's one thing having access to data. It's another thing being able to evaluate and analyze that data as effectively as possible as well.
And I think that goes to my first 2 points, right? Not having the sort of technical skills and then stemming from that, the confidence. Because, at the end of the day, right, like, we spend over 6 figures a year on data. So if individual investors have got that sort of money to be able to spend on data just for one property purchase, the data's going to end up being 1/5 or 1/6 or 1/7 of probably the purchase. Fill your boots, but you got to combine technical skill, you got to combine financial resources, and then time. Like,
exactly right.
Like you think we've got a team, so we get multiple people 8 to 9 hours a day at a minimum. Like in let's say like 3 of our team doing 8 hours a day, that's 24 hours get devoted to data and research analysis in one day. For most people, by the time they go to work, get home, have dinner, spend some time with the family, chill out, whatever, they'd be lucky to get 2 hours. So what takes us 1 day of output is going to take them, 48 days.
Yeah, exactly.
Sorry,
right.
reverse weight, 12 days. Reverse. Half of 24, not double of 24. It's going to take them 12 days to get what we get as an output in 1 day, So it's time as well. Like I think it's all those factors.
Well, time is probably the biggest thing one of the biggest things anyway that we see come through the doors at Atlas. People struggling with time. They've obviously got a busy 9 to 5 or, working even later hours. So find the time after you're mentally exhausted to then, look into data, scrutinize it. Like it's a lot for a lot of people.
Absolutely.
Right?
Absolutely.
So, well, mate, let's actually jump into the good stuff now. So as I mentioned, we're talking about market pressure indicators at 3 different levels. Let's start off with supply pressure indicators.
Yeah.
Let's kick it off with that. And I think there's a couple of different points in that, but let's start off with the first one, which is listings.
Yeah, okay.
Can you elaborate on that?
I like this one. So the first thing I want to say before we dive into any of this stuff, before supply or demand or the rental side, I want to make it really clear to everybody that no piece of data is good or valuable or meaningful in isolation, right? Like you go and look at a number that might typically mean that it's in a good range, but if that number is trending upwards and it's been not just trending upwards but skyrocketing upwards, that is far more of an important thing, that trend, rather than just the number. So I want to make that clear. No number in isolation is meaningful. You need to understand the broader picture behind it, right? Which is trend analysis, right? But that's my little soapbox moment, just to make sure we've got the disclaimers out of the way, right? But listings. So, supply is excuse me, is the availability, right? So listing data is really important and valuable because it can help us to understand how active a market is, right? And just because there's a really high number of listings doesn't actually mean it's a bad thing, because if a market is moving and people are buying, odds are listing numbers have actually increased. So it can often actually be a good sign. What we just want to see, which is what we're going to talk about next, is inventory, is we just want to make sure that those listings are being absorbed, i.e. acquired, bought, right? Because if you've got listings that are up by 30%, but buying isn't up by 30%, that's obviously an issue, But it's really important to understand that trend, and you can look backwards to sort of understand, and you can look across markets as well, like look at neighboring suburbs, look at neighboring geographies, right? You can often see the trend that occurs when things are going really well, and that's people go, oh man, like my neighbor's property's gone up, he's selling it. Maybe should we jump on the bandwagon? Should we jump on the bandwagon? And then they list their property, and then the next neighbor across the street instead of next to them goes, oh, I'm going to do the same. And then 2 suburbs over, grandma does the same thing because she's now ready to go into the retirement home. Like
that's a snowball.
It is,
effect,
right? It's and a lot of this, I will say, I'm going to probably bring up a bunch of times, is sentiment and confidence. So listing info, really, really crucial, important.
Okay,
really
listings. Crucial. Okay, next one.
Inventory.
Inventory.
As I said, I gave a little teaser before.
Yeah.
So, inventory is a really great measure because it helps us to understand how many properties that are on the market versus how many properties typically sell in a month. So you'd express inventory in number of months. You'd say, oh, there's currently, 3 months of inventory on the market, right? And the reason why that's really helpful is because you can understand, well, if there's 3 months or 4 months of inventory, it means that, okay, well, then most properties are then, starting to take a little bit of time to sell. So it helps you understand how much is sitting there out of that listings done. That's why I said listings and inventory are really linked, because inventory is basically how many properties typically sell in a month divided by how many properties are available in a month, right? Or sorry, no, it's the other way. It's how many properties are listed versus how many properties are going to sell. Right.
Okay. So if you've got a market where it's currently got an inventory level of, say, 4, that would then tell you that it's got 4 months worth of inventory. So it would take 4 months to essentially sell off that stock.
Typically, yes, exactly right.
Okay. So then if you're following the trend of that and that's gone down from 4 to say 2.5 months, what is that telling you?
Well, that says, right, like stock is starting to be absorbed a little bit quicker because you've gone from 4 down to 2.5. So it can often be a really healthy sign that a market is moving. Now, one of the biggest issues though that comes about, and it's something I've actually noticed a lot more over the last few years, is that what typical inventory numbers or some other metrics that we're going to talk about, typical numbers that would have been associated with, say a stronger market or a sort of balanced market or a weaker market are starting to actually be a little bit skewed, and starting is probably not even the right word. They are starting to be, they are, I said starting again, they are being skewed by the fact that we do have a critical shortage of properties in most places around the country. So what that means is that you can actually go and see in some markets, the numbers in isolation are not too bad. But then there isn't necessarily performance. And that's just because of that critical shortage. But it just means that in those markets, whilst they might be sitting numbers-wise at a solid level, this is where that micro research and that on-the-ground perspective and really understanding your market becomes important, because you might go and talk to agents and they'll say, look, stock's moving.
Yeah,
stock's moving. We're listing things. We've got some inventories there. It's moving, but it's moving at a pretty regular pace.
Yeah, right.
Right? So that's why, again, this whole idea of you can't look at anything in isolation is so important. Yeah. So, I'll give you an example, right? Ballarat. We got together a few examples, and we've only got 2 examples for 2 of the metrics, and I'll tell everyone why. It's because a lot of the metrics, just because one of them went down or up or something like that, isn't the sole reason why a market may not have performed. And it's really hard to, and that's why I said nothing can be taken in isolation. It's, you have to look across a lot of factors, right? So I started sort of, and I'll be honest, I cherry picked a few of them just to show a bit of an example. But, the first one I want to talk about is a place called Winter Valley in Ballarat, right? Now we all know Victoria, not been the best place to invest for a few years now, and we can thank the Victorian government for a fair chunk of that. But coming to Winter Valley in Ballarat, so prices started to dive around mid-22. Now, everybody knows around mid-22, we're starting to see, interest rates were back on the cards for discussion and everything that was happening there. We're seeing the Victorian government starting to make some very silly moves, and they'd previously made a couple of silly moves in the 12 to 18 months preceding. So there was, this is what I mean by there was a number of factors that were kind of at play here. But for the purposes of cherry picking a little bit of a data point here, that kind of, it does fit the narrative, but it's still, we know that this stuff works.
Yeah.
So when prices started to dive in mid-22, we saw that there was also quite a rapid increase in the inventory available in the area before this, right? So what anybody who was monitoring the data would have been noticing would have been going, okay, well, prices were starting to taper and taper and taper. Oh, well, inventory's also started to creep up, i.e. properties are being listed, but they're not as many are being sold, so inventory numbers start to creep up.
Yeah.
And inventory stayed high pretty much since then. And over the last few months, we're down over 6% in property value, and inventory has still continued to stay quite high at some of its highest levels. And you can see that because at the end of the day, supply and demand rules everything, and supply is well and truly not in balance with the demand.
Yeah. Yeah. Which brings us to our last point, carving out supply pressures.
Yeah.
The enemy of capital growth.
Yes.
And this is talking about, construction and approval rates of these construction projects. So
everybody loves, I mean, oh God, I feel like we talk about this in the office quite a lot. Everybody's always, really talking and looking, sorry, I'm just moving my mic here. Everyone's always really talking about, what's coming, what's being built, what's coming here, you know, how much development are we expecting to see?
Yeah.
You know, talking about the macro, you know, oh, what sort of infrastructure going on and all this sort of stuff. And one thing a lot of people really tend to focus on is, well, what are some of the approvals that are coming through? You know, how many dwellings are being approved in this area? And then, you know, how's that compare with current stock?
Yeah.
What's it going to do? You know, like that's the big question. What's it going to do? And, you know, I think approvals are obviously really important because it gives a top line indication of what's going on. But something that a lot of people don't go to the next level on is looking at the actual construction numbers, because not every dwelling that gets approved is then constructed. So you might go and have an area that has got a ton of approvals, but nothing's been constructed. So supply actually isn't changing in that area. Now, you've obviously got to be wary because they've got the approval, but that's where you have to start asking the questions of why. And, you know, like let's talk right now. Higher interest rates than we've typically had, right? It's quite cost prohibitive right now. We've got cost of labor through the roof, right? Like Australia has descended into a place of low productivity. It's through all the RBA minutes. We've got red tape and regulation everywhere. We've had unions who have struck amazing deals for their members, but it's also come at the cost of productivity and viability of a lot of projects in sort of real estate and property development. So we're at a point where we're at some of the lowest construction levels, if not, I think I was looking at the data just in prep for this episode, we're at the lowest level of constructions since about 2011 nationally.
Yeah, wow.
Right? So like in the last 13 years, despite the fact our population is skyrocketing, has
exactly
skyrocketed
right.
and will continue, right?
Yeah.
So my point out of this is right now, there are actually heaps of people doing approvals, which is really smart, but the sites aren't viable. Deals aren't viable, but they're getting all their ducks in a row because when projects then start to become viable because rates come down, maybe a few of these, you know, like wage deals, what are they called? The enterprise agreements and stuff like that. Maybe a couple of them get renegotiated, whatever. Projects become viable, approvals are seen they're ready to go. But this is why it's so important to understand the distinction between the two, because whilst it's a risk, nothing's happening right now.
Yeah.
You know?
Very interesting. Very interesting insight.
What do you think of it? What do you think of it? I've done so much talking today.
Mate,
I know this is. I know I got the expertise here, but like, what's your thoughts on it?
I know you love a yarn. Well, look, I think there's a massive supply shortage in the country, and to obviously cater to the ever-growing population, we need to be building more properties. I think there was, I don't know the stat off the top of my head, maybe you can recall this. It's 1.2 million properties that the government wants to build by, I think it was the year
2030 off the top of my head, yeah.
Yeah, 2030?
Yeah.
So at the rate in which we're going with approvals and construction rates, like we're just not going to hit that number.
Well, I can tell you where it officially started as of July. From memory, I'm going off the top of my head. I think I actually talked on another podcast maybe a couple months ago about it, but from memory, it started in July.
Yeah.
It runs to 2030. So it's starting in July. We're roughly 6 months in, roughly.
Yeah.
We're already behind target. And yet, of course, that doesn't mean we can't pick it up. But targets were set very recently, knowing the current economic conditions that we're in, and we're already behind.
Yeah.
So what does that have to tell? Well, you know, what do you take from that?
Yeah. Well, look, if more and more people are pouring into the country, the government's going to have to do something about it, right? Like you'd think. You'd like to think that.
Oh, that's a big call. They should do something about it, but will they do something about it? But that's the biggest issue. And like I said before, one of the core impacts right now, it's a bit off topic to market pressure indicators, is productivity in Australia is so low that we have become, I was reading it, I think it was last week, I think we're like literally one of the least productive of the, you know, first world countries.
Really?
Yeah.
Wow.
Productivity in Australia is so low, and like my personal belief is a lot of it has come from the fact that we've just put red tape and regulation through everything. Innovation is just a buzzword now. Like there's no real value to taking risk for a lot of people, whether it's in business or property or other stuff. it's all been stripped out. So because of that, productivity has dropped as well, because people know, oh, I'm going to get my 5 or 7% wage increase. I'm going to get, like my union's going to go on and smash whoever it is about getting a massive deal. Yeah. So people are happy to just kind of coast along, and that's fine. But the issue is that it then impacts the economy like massively, and people struggle to be able to do better for themselves even if they want to, Yeah,
interesting. Well, I'll tell you what, productivity at Atlas is pretty up there, mate. You got the whip, cracking the whip out on us. But I guess that kind of carves out supply pressures.
Yeah.
Let's now shift gears and dive into demand pressures.
Yeah.
Right?
Do you demand that of me?
I demand that of you immediately.
Immediately?
So look, I think the first one that I think I want you to expand on is days on market for the audience.
It's interesting. I really like this one because I feel like this is honestly just my 2 cents on it, right? Like this, there is no science to back this up. There's no science to back this up whatsoever. But I feel like I just really like analyzing the demand side more than I like analyzing the supply side, because I feel like the demand side always has such a more interesting story to tell, because like no matter what level of supply, that doesn't really account for like human emotion. Like I really like the psychology behind real estate and investing and everything. And when you're looking at the demand side, it really takes into account that psychological aspect of it, because like you might have an area that is oversupplied, but you could also see that like there's still really quite a lot of demand that sits there. And then that makes me go, well, why? Like, and I get taken down that rabbit hole of like, why is this like that? Why is that like that?
Kind of almost like a bit of a detective.
A bit of a detective. I don't know. Like I said, it's just there's no science or rationale to it. I'm certainly not saying the demand side is worth more than the supply side. Just I find the demand side so much more interesting to look at, And something like days on market, is a really interesting sign, a really interesting indicator sign. To look at, because to me it speaks directly to the psychology of how people feel about a market at that point in time. Like it just speaks directly to it. So days on market, just simply put, is the amount of days a property would sit on the market available for sale before it actually sells. So it's just expressed in days, right? So you go 20 days on market, or 15 days on market, or 45 days on market. And I also find it's a really interesting measure because it is so prone to skew, right? Yeah. So using a data term, it's so prone to skew because like every data provider measures it slightly differently. But the biggest issue that comes out of analysis on this, and this is why my personal perspective on it, as soon as I see days on market sort of at like maybe below, let's call it 15, maybe even 20 even, I kind of take that as like the market is so hot that a property basically sells within a few days of it going online. And I'll tell you why. So days on market usually is calculated by looking at what was the first date of the listing and then what was the date that the agent has said that the property sold, right? So how you think, oh, well, how can that be skewed? Like it's pretty simple. Like there's one day it went on and there's one day it was sold. But the issue comes because it relies so heavily on how the agents operate. So let's say you go and buy a property and you buy it with conditions in the contract. Like, let's say you got a finance clause in there, right?
Yeah.
Some agents might go, and the minute that you sign the contract, they mark the property as sold online, right? So that shows probably the most true reflection of that's how long it took, right? You then might get another agent who goes, well, you know what? I'm going to wait until that condition is satisfied. So if you've now got, say, 14 days for your finance or 21 days for your finance, and let's say you took 5 or 6 days to, agent puts it up, agent actually wants to show the property once or twice. Let's say it takes a week to officially get it all signed off. You got to put the contract in front of lawyers, reviewed, blah, blah, blah. You go, well, 21 days for finance, 7 days for just the starting period, you're suddenly now 28 days. But the reality is that you actually lock that property up in 7. It's just that the numbers now going to reflect 28, right? And there are different variations of that can go on. But that's why I find it really interesting, because it is so easy to skew, because you don't really know how it's necessarily being done. And then some agents, they might then go and backdate it. They'll go and say, oh no, we waited until then, but then it's sold will mark the sold date as the date of exchange, you know?
Yeah.
So anyway.
Interesting.
Yeah. Long story short, I find it a really interesting metric. And that's why for me personally, when I see it definitely below 15, but even probably sometimes below 20, I just go, you know what?
It's going to be tough.
To get into that property, you got like 3 or 4 days, right? From the moment it's listed, you got to get all your due diligence done and rip through as fast as you possibly can.
So is that the kind of heat that you'd be wanting to look at in a market though?
Absolutely it is.
But then also, how much can that market sustain that heat, right? But before you kind of feel like, you know, it's kind of reaching its limit, you know, it might be a good time to look to get out. Or on the opposite side, what about a market that's kind of got days on market that are around like 30, 35, but you're starting to see it on a bit of a downward trend. When's the right time to get in?
Well, that's the magical question, isn't it, right? Like that's the secret sauce. It's the secret sauce of what we do. It's the secret sauce of anyone who's good at property investing. Look, honestly, the answer is probably it depends, and I don't know, whatever you want to say, because like, you know, some markets, like even some markets that we invest in at Atlas, they've had days on market sub 20 for 12 to 18 months, and it's still there, right? So I think that's where it also is important, and this is why no single number can be used as the secret sauce or the gold. You have to look at multiple metrics. You have to overlay them together. You have to understand how they think. You have to understand the psychology. You have to understand the on-the-ground point of view. You have to bring all those things together, and that's why it's so hard to be really successful, right? So, you know, like to me, it is all about the trends, though. You know, so if you see that, what did you say, 35 days or whatever
35, 40 days, and it's starting to go on a bit of a downward tear.
Yeah. So cool, awesome. That looks good. All right. How does inventory look? What are listings doing? Are they starting to tick up and yet inventory is still coming down? Because that's a good sign. More people listing, bit of heat. But if more properties are being listed and inventory is coming down, it means more properties have to be getting sold. Days on market starts trending down as well. So, things move faster.
Piecing the puzzle together, putting the narrative together.
Absolutely. Yeah. You know, what else is going on? What are our, you know, like agent colleagues on the ground saying that, you know, we might try to do a deal with them to go, okay, well, you know, if we do a deal, like what are timings looking like? You know, like, and they go, oh no, you've still got a good like 3-4 weeks. I go, okay, well maybe it's not, the data's looking better, but the agents aren't feeling that heat yet. But then when the agent turns around and goes, hey, you got about 2 days. I'll give you 2 days to be able to do your stuff on it. Then I start to go, shit, that's quick. Yeah. You know, like there's heat, you know, bit of hot sauce in there.
Yeah. Very, very nice. Love my hot sauce.
You love No, you don't. Do not be a liar here.
Come on. I'm getting better, man.
You're getting better? I'm not going to let you lie.
Year and a half ago, couldn't touch it, but mate, like it's growing on me.
Is it?
Love a bit of heat. But I guess to tear through this, just because mindful that we want to get through the rental pressures as well.
Yeah.
To kind of round out the demand pressure, the last thing that we want to kind of chat about is vendor discounting.
Yeah. Yeah, absolutely. Look, I'm going to be really honest. I don't even really like vendor discounting much as a metric. I find that it's really easily skewed, and even in markets that are super hot, I find that, like, for example, well, I'm just trying to think about what I'm trying to say here. In markets where properties get listed at a certain price, but anybody who operates in that market knows that properties always go above that price, and I go and see, and I can see the fact like, oh, there's still like 3% as the vendor discounting. Yeah, that's where I start to go, I don't love this data point, right? Because I go, well, you know, I can see every deal that we're looking at is going for 30, 40, 50K over. And that's not just deals that I'm not saying that's deals we're buying. I'm saying, you know, that could be a deal that we buy because the agent's underrepresented on the listing price. Yeah. But even deals we miss out on, like we might offer 40K over because we know the value sits there, but then somebody else comes through, it could even be another buyer's agent, and they're 65 over. You go, okay, well, how can there be 3 or 4 or 5% vendor discounting in this market? I don't love it as a metric, but I would say it's probably more useful for trend analysis again, and it's probably a running theme, is the percentage number that it is, you know, like 3% vendor discount, whatever it is, maybe isn't so important. But if you can see that vendor discounting is decreasing, that's probably a better sign, you know? But I would definitely say just just because you see vendor discounting as a certain number there, I certainly
something to be cautious of, right? Because
Yeah.
you could have agents that are kind of win the business of the client and say, Lockie, I think your property, I think it'd go for 1.5, 1.6. When in reality, they probably know that realistically, it's quite a bit less.
Well, we all know agents play the game.
Yeah.
We all know agents play the game. But so I think like we obviously only have so much time. So I thought we'd only maybe do like 2 of those demand pressures there. There are more pressures out there, but I'm having a look at the clock. We're almost 40 minutes in,
Oof.
so time's already escaping us. So I think I don't know. I think maybe rental indicators is a good one to round out on.
Yeah.
What do you reckon?
I think so, mate. So first one that we've got here is rental yield. And this is an interesting one because when you look at data and you look at that interrelationship between rental yield and median price, to the untrained eye, a person's going to look at that interrelationship, and if that rental yield is going down, they might be thinking, well, that's a terrible market to go into. But it could be because that market's seen a really nice, healthy burst of growth coming to the market.
Exactly right. So, the only reason I'm not talking about like listings and things like that in this is because it's the same as like the sales market. It is still an important one. So we're only going to talk about 2 rental indicators. And I just want to pick them because they're a bit different to some of the other things we've spoken about. Yeah. Because a lot of the things that we've spoken about for the sales side can actually then be applied to the rental side, right? So I just want to say that to everybody. So in the spirit of doing a couple of other different ones. So like you said, rental yield, right? So God, how often do we hear that? Like you see a rental yield going down and people go, oh my God, like what's wrong? Yeah. Must be something wrong. But rental yield is really interesting because rental yield is basically, so when talking about rental yield, we're typically talking about the gross yield, right? In residential, we deal with gross yield. We don't typically deal with net yield because it's not the most fair of equivocations compared to say something like commercial property. So residential, it's gross yield. So that's what we're talking about here. And it's really interesting because it's basically an expression of the rent against the value of the property, right? So it can be a really interesting way to kind of quickly assess the rental side of one property versus another one. And when we're talking about market indicators, it's really crucial because it helps you understand your cash flow or potential cash flow on an asset, but it also helps you understand the market, right? Because there's 2 sides to this, right? It's property value and it's cash flow, right? Or the rent. So if that's going down, there's typically only 2 reasons for that. Either property values are going up or rents are going down. But I would say in most good markets these days, the reason why it's called yield compression, that's the term. The reason why this happens, why 5% suddenly 6 months later is 4.8%, is because the value of property is increasing in that market faster than the rents are increasing. So both are actually going up, which is obviously a great sign. Yeah. But because typically the property value in strong markets is going faster, you do the simple maths on that. It's the denominator in that, the bottom one in a fraction. It's just for you, Lukey. I know sometimes you struggle to see it there. Because it's the denominator in that, when that goes up and it goes up a lot faster, it brings that calculation down. So it makes it look bad. So what do I want to say about it? I guess what I want to say about it is it's great for assessing your cash flow, potential cash flow, but it's really important you understand the underlying factors on why it might be changing. Because then it could be the flip side. It could be it's actually going up and rents are staying the same, but property value is then going down. And then it makes you go, okay, well, why is that? That could be maybe cause for concern. Yeah. Or maybe property values are staying neutral and maybe we're just at a different stage of the cycle of the market and rents are increasing. At which point, depending on whether we're having this discussion before a purchase, so might make you want to question whether you should if the prices aren't moving, or it's an asset you already own and it's just in this different cycle, it still helps you understand, but you really got to unpack why the yield is changing before you make a decision. Yeah, very well said. And then I guess to kind of, cover off the last of rental pressures, we've got vacancy rate as well. Yeah. And this is something that's interesting because obviously when I speak to clients, they hear these buzzwords, they hear about, wanting to be under a certain vacancy rate to ensure that, if that property does go vacant for whatever reason, they can get
tenants in quite quickly.
Yeah.
So they're not so much out of pocket.
Yeah.
What is a realistic vacancy rate in the current market, and where should we where should we be kind of aiming for, I guess, as well?
Yeah. Well, so I guess firstly, so vacancy rate is basically an expression of how many properties in a market are vacant at any one time, right? So a higher vacancy rate implies there's more properties vacant, which then gives the inference that if there's more properties vacant, that maybe it isn't as desirable, right? That's the way vacancy rate basically ties together. So it's a really interesting way you phrase that question. So you phrased it in the current market. So traditionally, vacancy rate has typically hovered at around 3% in a balanced market, right? Now, because we do have a critical shortage of properties, I haven't actually run the numbers on it because you have to look at it on a national scale, which we obviously have the capabilities to do, but we haven't really looked at it. You'd have to go and look at it again, but I would potentially hazard a guess that maybe that idea of a balanced market has actually come down a little bit. But for all intents and purposes here, I'd still maintain it at about 3% because at the end of the day, as long as your property's being rented, that's the most important factor here. But it's interesting as well because different data providers assess it differently. So I'd say the most typical way it's assessed is how many properties are still vacant 21 days after listing, right? That's typically how it's done. But again, different providers might put slightly different skews on it. But it is really handy to understand what's going on because if understanding that trend in vacancy rate is really important because I think about some of our property market reports, and because the vacancy rates in the areas that we invest in are so low, like often
sub 1%.
I was going to say sometimes sub 0.5%, which is basically more of a statistical anomaly rather than anything else. When it then swings and it goes from like 0.5 to like 0.9, yes, it's technically almost doubled, but it's still at such a critical shortage that it could have just been a bad month. Like it's just a bad month. But then when you see it on a chart and in the charts that we give to our clients about the areas we're investing in, it then looks like it's just absolutely like boomed in a bad way. So it's always really funny to kind of see that.
So then how do people then evaluate that kind of data metric? Because as you mentioned, critical shortage in the country, most markets would have pretty low vacancy rates, I'd imagine. So what's the big difference between a market where it's 2% currently compared to something that's maybe like 0.5%?
Well, I think at the end of the day, the most important thing is your property's getting rented, right? Like it doesn't matter whether a market has 10% vacancy rate or 0% vacancy rate. All that you should really be concerned about is your property going to rent, right? So obviously we're not going to invest in a market with a 10% vacancy rate. But my point is that like if you got a 2% market versus a 0.5% market, I wouldn't necessarily say that means one is necessarily worse than the other or better than the other, because the most important factor is your property gets rented. And that's why it's so important that
do you think that might give you a bit more leverage in terms of trying to ask for a bit of an increase in rent perhaps? Or?
I mean, maybe, but at the end of the day, and I guess this is probably where I was leading with it, was that's why your team is so important, right? So having a good property manager, because you might be in a market that you could have been looking at two markets. One has 2%, and one has 0.5%, right? But at the end of the day, if you buy the most hot, in-demand type of property in that 2% market, your property might be rented in 3 days flat. So it doesn't necessarily take into account all the other sub-factors that go along with that. So that's why having a good team, like for example, a property manager, is so crucial, because no matter what the percentage is of vacancy rate in a market, if your property manager is going, I rent 10 of these a week, these are brilliant, buy this property, it could have a 5% vacancy rate or a 1%, but if they say the same thing, all that you really care about is that you're getting your property rented. Of course, and this is my last caveat because I know we're running out of time, of course you want to understand the reasons that drive that, right? So like it's, and you know me, that's always my right. Like I must say that to you, I reckon 10 times a day with different things. You always have to understand the reasons why, because obviously it's not just about getting your property rented. You want to make sure there's longevity there. You want to make sure the market's still going to be a good fit. So there is lots more to unpack. So I don't want to make it too simplistic or reductive, but if you understand those factors and you also buy what's in demand, you're going to have a good result.
Very well said. Give the voice box a rest, mate. I think you've done well. So I think to kind of, round out and provide some takeaways for the audience that are listening. So the big three things are, number one, trends are most important, not looking at numbers in isolation, number one.
Yeah.
Number two is data and analysis removes emotion out of the investing decision.
Yeah.
And then do you want to hit us with the third one?
Do I want to hit you with the third one? I would say the third one is being confident in what you're doing and what you're analyzing, because you can go and pay for all sorts of data. You can sit there with spreadsheet open, but if you don't know what you're doing with it, it doesn't matter, you know? And like you can, I mean, how many times do we have clients send us spreadsheets and stuff like that?
I had one last week.
How many times do we have clients send us spreadsheets where we look at it and we go, you know, it's obviously amazing that they're trying to be really involved in what's going on. But when there's fundamental flaws in it, in the analysis, it doesn't matter how pretty or good a sheet might be, whether that's area analysis, portfolio analysis, whatever it is. You've got to be confident in your knowledge and know what your limitations are. And if you have certain limitations that you can't be beaten, get help. Don't just try and muscle your way through it, because the only person that's going to hurt is you. Yeah. You know? What do you think? Good episode?
I think it was a juicy episode, mate. We've done well. I think that's 50 minutes on the head.
50 minutes on the head, hey?
Yeah, mate, I've enjoyed this chat. I think you've obviously shared a lot of insights today. Yeah, I think you definitely need to have a bit of a rest. You're picking up a bit of a sweat there. So
a bit of a sweat. I'll tell you,
get the towel.
It's the lights in the studio. They're so hot, man. They're so hot, mate. Look, thank you. I really enjoyed the chat, and thank you to everybody listening in. We really appreciate your time. We hope that we're delivering you a lot of value. And I guess to round out the episode, the couple of things I'd say is, first, if there's anything you'd like us to talk about, please let us know. You can get in contact with us via the Atlas Property Group website. Let us know. We'd love to hear about things you'd like for us to cover, or questions or anything like that. We've got a lot of episodes still to go. So let us know about that. And I think secondly, you know, if you want to come and work with, you know, leading REB finalists, you know, we were 2023 Buyers Agency Champion of the Year. If you want to come and work with a team that knows how to win, is winning awards for innovation, has got all this data and understands how to use all these metrics, and has a very, very strong performance rate, come and have a chat with myself and Luke and the broader team at Atlas Property Group. You can book in for a chat with us via our website, atlaspropertygroup.com.au. But other than that, we hope that you're having a great start to your year, and we can't wait to be back with you soon.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.